Have you ever wondered how the global pandemic has affected the world of Forex trading? Well, let's take a journey and explore just that. The immediate impact of the pandemic on Forex trading was like a shockwave, sending ripples of volatility and uncertainty across the globe. As countries went into lockdown, economies ground to a halt, and the Forex market, like a sensitive seismograph, picked up every tremor. When people couldn't go out, when shops closed their doors and industries slowed down, currencies responded. The US dollar, traditionally a safe haven in times of crisis, initially soared, while emerging market currencies took a nosedive. But as central banks around the world started pumping money into their economies, the tables turned, the dollar weakened, and those emerging market currencies started to claw their way back. But that's not the whole story. The pandemic also sparked a surge in retail Forex trading. As people found themselves working from home or in some cases out of work altogether, they sought new ways to make money. And in the world of Forex trading, where all you need is an internet connection and a small amount of capital to get started, many found a new venture. In fact, globally, retail Forex trading saw a significant increase during the lockdowns. Yet, it wasn't just the novice traders who were affected. Even seasoned traders had to adapt to the new normal. The pandemic brought unprecedented levels of volatility, and with it, both risk and opportunity. Traders had to be nimble, adjusting their strategies to keep up with the rapidly changing market conditions. The pandemic has indeed reshaped the Forex trading landscape. But what are the specific trends that emerged during this period? Well, as we move forward, we'll delve deeper into those trends, the strategies that proved successful, and the role of central banks during these tumultuous times. So, stick around as we navigate the fascinating world of Forex trading in a post-pandemic era. As we navigated the stormy seas of the pandemic, several new trends emerged in the Forex market. One of the most noticeable trends was the rise of digital currencies. Yes, you heard it right. Cryptocurrencies have become a new frontier in the Forex trading world. During the pandemic, the world moved more towards digitalization, and currencies were no exception. A significant number of traders started to explore this new avenue, contributing to the volatility and liquidity of the Forex market. The currencies that once were the stronghold of the Forex market, like the dollar, euro, and yen, started to share their space with Bitcoin, Ethereum, and other digital currencies. While digital currencies brought a fresh wave into the Forex market, they also introduced new challenges. The high volatility of cryptocurrencies means that traders can potentially reap high rewards, but they also face a higher risk. This trend, in turn, led to an increased risk appetite among Forex traders. Now, let's talk about this increased risk appetite. The pandemic was a time of uncertainty, and traditionally, in such periods, traders would move towards safe haven assets. But the pandemic flipped this narrative. Instead of retreating, traders pursued higher risk, higher reward strategies. They started to look beyond the traditional safe haven currencies and diversified their portfolios with riskier assets, including digital currencies. A contributing factor to this shift was the low interest rates maintained by central banks worldwide. With low returns on bonds and savings accounts, Forex trading became an attractive alternative for many. But remember, with higher risk comes the potential for higher losses. So while the increased risk appetite allowed traders to make significant gains, it also led to substantial losses for some. These trends have not only changed the way we trade, but also the strategies we use in Forex trading. The rise of digital currencies and the increased risk appetite among traders have added new dimensions to Forex trading. And as we move forward, these trends are likely to shape the future of Forex trading in a post-pandemic world. With these new trends and increased volatility, traders had to adapt their strategies. What worked pre-pandemic may not work now. The foreign exchange market, or Forex, is a world that is constantly evolving. With the arrival of the global pandemic, the rules of the game have changed. The shift from long-term strategies to short-term ones has become more pronounced due to the increased market volatility. In the pre-pandemic world, traders could afford to hold positions for weeks or even months, riding the wave of long-term economic trends. But today, these trends are more unpredictable and can reverse rapidly, making short-term strategies more viable. This shift is not just a change in time frame, but also in approach. Traders are now relying more on technical analysis, the study of price patterns and trends in the market. With the pandemic causing sudden and dramatic shifts in the economy, fundamental analysis, examining economic indicators and political events, has become more challenging. The numbers and events that used to guide traders are now often overshadowed by the market's emotional response to the latest pandemic news. This increased reliance on technical analysis does not mean fundamentals are no longer important. On the contrary, they're crucial for understanding the context in which technical patterns are forming. It's just that the balance has shifted, and technicals are now often the deciding factor in a trade. In this new trading environment, risk management has become more important than ever. With increased volatility comes increased risk, and traders must be careful not to get caught in sudden market swings. This means using stop-loss orders to limit potential losses, adjusting leverage to manage risk exposure, and diversifying trading portfolios to spread the risk. It also means being mentally prepared for larger price swings and understanding that losses are a part of trading. It's not about winning every trade, but about making more on your winners than you lose on your losers. And in a volatile market, this means being patient, waiting for the right opportunities, and not rushing into trades. The pandemic has also highlighted the importance of staying informed and flexible. The situation is constantly changing, and traders need to keep up with the latest news and adapt their strategies accordingly. This could mean trading different currency pairs, adjusting trading times, or even taking a break when the market is too unpredictable. In the end, trading is about more than just strategies. It's about mindset, discipline, and adaptability. And in a post-pandemic world, these qualities are more important than ever. Adapting to these changes is crucial for success in Forex trading today. It's not easy, but those who can navigate this new landscape will find opportunities where others see only challenges. It's a new world out there, and it's up to us to make the most of it. One cannot talk about Forex trading without mentioning the role of central banks, especially in a post-pandemic world. Central banks around the globe have been instrumental in shaping the current landscape of Forex trading, more so during the pandemic. The actions they took, like lowering interest rates and quantitative easing, have significantly influenced Forex trading and currency values. First, let's talk about interest rates. Central banks slashed rates to historically low levels during the pandemic. This was a move to encourage borrowing and stimulate economic activity. But how does this affect Forex trading? Well, lower interest rates typically mean a weaker currency. This is because investors migrate their investments to countries where they can get higher returns. So, when a central bank lowers its interest rates, its currency tends to depreciate against other currencies, creating trading opportunities for Forex traders. Moving on to quantitative easing, another crucial tool used by central banks. This is when a central bank buys government bonds or other financial assets to inject money into the economy. It's like pumping cash into the system to keep it afloat. The effect on Forex trading? Quantitative easing increases the supply of money, which can lead to depreciation of a currency. This too provides opportunities for traders to profit from currency value fluctuations. Let's look at a concrete example. During the pandemic, the US Federal Reserve implemented aggressive quantitative easing measures. This increased the supply of the US dollar, causing it to weaken against other currencies. Forex traders who anticipated this move could have profited by selling the US dollar. But it's not just about interest rates and quantitative easing. Central banks also play a role in stabilizing the Forex market. They can intervene directly in the Forex market to prevent their currency from becoming too weak or too strong. This is done to maintain the competitiveness of their country's exports and to control inflation. Moreover, the communication from central banks can cause significant movements in the Forex market. Statements about future monetary policy can lead traders to anticipate changes in currency values. For example, if a central bank signals that it might raise interest rates in the future, Forex traders might start buying that currency in anticipation of its appreciation. In a post-pandemic world, the role of central banks in Forex trading has become even more pronounced. Their decisions on monetary policy, like whether to raise or lower interest rates or to implement quantitative easing, can create ripples in the Forex market. These monetary policy decisions are also influenced by the state of economic recovery from the pandemic, adding another layer of complexity for Forex traders. The decisions of central banks continue to play a significant role in Forex trading, perhaps now more than ever. Understanding these dynamics can help traders make more informed decisions and potentially profit from the ever-changing landscape of the Forex market. So, what does the future hold for Forex trading in a post-pandemic world? In the wake of the global pandemic, the world of Forex trading experienced seismic shifts that will likely reverberate for years to come. As we look ahead, we see a landscape that is both challenging and ripe with opportunities. Firstly, let's talk about volatility. Volatility is the heartbeat of the Forex market, and the pandemic has undoubtedly amplified it. Economic uncertainties, uneven recovery rates across nations, and changing fiscal policies have all contributed to increased fluctuations in currency values. This heightened volatility can be daunting, but it also presents traders with opportunities for higher returns. As we move forward, traders will need to hone their risk management strategies to navigate these rougher waters. Next, we turn our attention to the digital revolution sweeping across the financial world. The rise of digital currencies, underpinned by blockchain technology, has been one of the most significant developments of the 21st century. The pandemic has only accelerated this trend as people sought contactless methods of transaction and investment. Cryptocurrencies like Bitcoin and Ethereum have gained mainstream acceptance, and central banks are researching and testing their own digital currencies. This digital transformation is reshaping the Forex market, offering a new asset class for traders to explore. The influence of digital currencies on Forex trading is only set to increase in the future. Lastly, we cannot overlook the ongoing influence of central banks. The pandemic has underscored the critical role central banks play in stabilizing economies during times of crisis. Central banks will continue to set the tone for currency markets with their monetary policies, interest rate decisions, and interventions. Traders will need to keep a keen eye on the actions and statements of these financial powerhouses to anticipate market movements. However, it's important to remember that the future is not set in stone. There are many other factors at play that could shape the future of Forex trading. Technological advancements, regulatory changes, geopolitical events, and shifts in economic power could all play significant roles. For instance, artificial intelligence and machine learning are making inroads into Forex trading, providing tools for more sophisticated analysis and automated trading. At the same time, the changing regulatory landscape could either spur or stifle innovation in the sector. In conclusion, the future of Forex trading in a post-pandemic world is a complex tapestry woven from a multitude of threads. It's a world that promises more volatility, further digitalization, and the continued influence of central banks. But it's also a world that is subject to the whims of technological innovation, regulatory changes, and geopolitical currents. While the future is uncertain, one thing is sure: the world of Forex trading will continue to evolve and adapt to whatever comes next. Now, let's summarize the key points we've discussed today. First and foremost, the global pandemic has fundamentally altered the landscape of Forex trading. Traditional ways of trading have been upended by the unpredictable fluctuations in the currency market brought on by the pandemic's impact on economies worldwide. This has led to a seismic shift in trading behaviors, with traders having to adapt to a new reality where uncertainty is the only certainty. Next, we discuss the emergence of new trends in the Forex market. The pandemic has accelerated the digital revolution, leading to an increase in online trading. More people are now turning to Forex trading as a means of income, given the flexibility it offers. This has led to an influx of new traders in the market, altering the dynamics of Forex trading. We also delved into the changes in trading strategies in a post-pandemic world. Traders have had to become more agile and responsive to market changes. They've had to rely more on data and analytics to make informed decisions, as traditional trading strategies have proven less effective in these volatile times. The role of central banks in economic recovery was another key point we touched on. Central banks worldwide have stepped in to stabilize economies, injecting liquidity into the market and adjusting interest rates. Their actions have had a direct impact on currency trends, making them a significant factor in Forex trading. Lastly, we looked at the potential future of Forex trading. While the pandemic has brought about challenges, it's also opened up opportunities for traders willing to adapt and evolve. The future of Forex trading will be shaped by those who can navigate this new landscape, taking advantage of the opportunities it presents. Remember, the pandemic has changed the Forex trading landscape, but it's up to you to adapt and thrive in this new environment.